Losing money in the stock market is never fun, especially when you are using strategy like covered call or cash secure put that are designed for consistent conservative income. But here's the truth. Losses are part of the game. What separates a smart investor from the average one is how you manage those losses. Today, I'm going to walk you through how I personally handle losing trades in both covered call and cash secure put, not with panic but with strategy. Whenever it's rolling, taking assignment, or simply cutting the trade and moving on, I will break it down step by step with examples. Part 1. Fixing a losing cash secure put. Let's say you sold a cash secure put expecting the stock to stay above your strike price, but now it's dropped below the strike price. You are facing assignment risk and the position is losing money. So, do you close it? Do you roll it? Do you just take assignment? Option number 1. Roll the put down and out. This is the most common strategy. If I'm not comfortable getting assigned at the current strike price, I will roll the put down to the lower strike price and out to a later expiration. Example, stock A, you sold $100 put, stock dropped to $99. You got 14 days until expiration. Rather than holding and hoping, you buy back the $100 put and sell a $99 put expiring in 30 to 45 days. This lower your break even and give the trade more time to work out. In most cases, you can do this for a credit, meaning you actually get paid to roll. Even if it's a small debit, it can be worth it. Think of it as paying pennies to make a dollar. Option number 2. Take assignment plus selling covered call. Now, what if you don't want to roll? Another solid option is to take assignment and then start selling covered call on the shares you now own. If I get assigned 100 shares of Amazon at $200, here's what I can do. Sell a $200 covered call to collect more premium while holding the stock, or selling a 205 call if I want to keep some upside potential. This turns a losing put position into a covered call income strategy. Type number 3. Cut the loser and move on. Let's be real, not every trade is worth saving. If the stock fundamentals have changed or the chart looks horrible, sometimes the best thing to do is just closing the position and moving on. Example, you sold a 230 put at Apple. The stock dropped below 215 on bad news. Rather than hoping it recovers, cut your losses and redeploy that capital elsewhere. There's nothing wrong with that. Don't let ego get in the way of smart investing. So now let's talk about covered call management. Covered call are great when the stock moves sideways or slightly up. But what if the stock shoot past your strike price? You face opportunity cost, you will miss out on the upside. When this happens, you have a few choices. Number 1, roll up and out to a higher strike and later expiration. Number 2, let the shares get caught away and book the profit. Number 3, or you can buy back the call, hold the position if you think there's more upside coming. It all depends on your market view and how passive or active you want to be. Now let's talk about when to roll and when to cut. When a trade goes against you, especially in options like covered call or cash secure put, it's critical to pause and ask yourself, do I roll this? Do I take assignment? Or do I just cut the loss? This decision shouldn't be emotional. They should be strategic. Here is how to think through each one in more detail. Roll the option when you still believe in the stock. Rolling means you are adjusting the trade by closing your current position and opening a new one. Either forward in time to give the stock more time to recover, or down in strike to align with the new price level or collect more premium. When should I roll? You believe the stock will recover in the near to mid-term. The company fundamentals are strong, with strong earnings, healthy balance sheet, good management, and competitive advantage. There's no major change in trend. Maybe the stock pulled back but hasn't completely broken down. Example, you sold $100 put on a strong company like Apple. The stock dropped to 95 due to macro fear or short-term volatility, not because of Apple business is collapsing. Instead of taking assignment, you roll out the put to the next month and maybe reduce the strike to 97. This gives the stock time to rebound back while collecting more premium. Why this works? Time and volatility are on your side. You are managing the position without realizing a loss yet and still generating income. It's about buying time and improving your cost basis. Now let's talk about taking assignment when you want to own the stock. Letting a put get assigned or letting your covered call get exercised means you are turning your option trades into a stock position. This is often part of the real strategy. When to take assignment, you are happy to own the stock at the strike price. You believe in the long-term growth of the company. You are ready to start selling covered call to generate income from your new shares. Example, you sold a $90 put on Google and now it's trading at 85. Instead of rolling, you let yourself get assigned and buy the shares at $90. Now you own the shares and can immediately sell a covered call at 95 or $100 to start collecting income. Why this works? You are building a long-term position at a discount thanks to the put premium. You turn the loss into an income-generating asset. You still believe the company has a bright future and wants to be a shareholder. Now we will talk about cutting the loss when things have changed. Sometimes it's better to close the position and walk away. This can be hard, especially if you are down $300 or $500 on a trade. But capital preservative is key. When to cut the trade? The stock breaks key technical support and enters a downtrend. The company fundamentals has become worse, like a poor earning report, bad guidance, debt problems, or industrial shift. There's better use of your capital elsewhere. New opportunities with higher upside and lower risk. The position is taking too much of your buying power, limiting flexibility. Example, you sold a $70 put on a speculative stock and now it's at 55. Upon review, you find earnings miss, growth slow, and analysis are downgrading the company. You realize it no longer fits your criteria, so you close the trade and move on. Why this works? You limit the damage and free up your capital. You prevent a bad trade from becoming a disaster. You protect your mental capital too. Staying stuck in losing trades can cloud your judgment on better setup. Here are my final thoughts. You don't have to be perfect in option trading, but you do need a game plan for when things goes wrong. That is the real key to long-term success. Rolling buy time and can improve your position. If the stock is still strong, assignment is powerful if you want to own the stock. Rolling buy time and can improve your position if the stock is still strong. For assignment is powerful if you want to own the stock and generate long-term income. Cutting losses is sometimes the smartest move, especially when the trade has lost its original edge. Knowing when to roll, assign, or cut will save your portfolio from death by 1,000 small losses and keep you focused on the next opportunity. Losing trades are common in option trading, but what you do with those losses is what determines whether you end up with consistent profit or a blow up account. Be flexible, stick to strong companies, always have a plan when things go wrong, because they will go wrong. If you got value from this video, make sure to like the video, subscribe, and drop a comment. How do you manage losing covered call or cash secure put? I would love to hear your strategy. Until next time, trade smart and stay profitable.